Welcome back to Let's Talk Tax. I'm Dave McGuire. Today I'm here with Greg Lambrecht to discuss international tax compliance and what CPAs often overlook in this area. Greg, thank you for being here today.
Excellent to be here, Dave.
So Greg, over the last few years, last few decades, I think companies have become a lot more global. Sometimes it's because they plan to, sometimes it's just, it happens. Business is not, it's the old world is flat kind of idea, but they might have like foreign suppliers, they might have subsidiaries, international sales, just operations across borders, foreign investors, something else. But I think people still overlook how important and how complex the international compliance can get and the effects that just that small little trigger may have on the compliance for the U.S. tax code. What do you think is causing that people to overlook that aspect?
Yeah, so I think to really get a good overview of this, we should think about what happened in 2017. So the Tax Cuts and Jobs Act was passed, and the complexity of the international tax world from a U.S. perspective was increased, I'll say exponentially, with the reporting forms, the requirements. And the example that I like to use is, so Form 5471 is for a U.S. company that owns a foreign corporation. And back in the day when I first started, we could do one of those. It was about 6 pages long. And it wasn't highly scrutinized. There was no real, there could be cases where there was impacting the U.S. tax return, but that was kind of rarity. Now, I've seen a 5471 as long as 100 pages. And almost every taxpayer is going to have a very difficult analysis that they need to do to make sure that they don't have a deemed dividend distribution that's actually changing their taxable income. So I think that was a real delineating mark, Dave, in regard to complexity. And then we just see a lot of companies that they realize the world's getting smaller and smaller. Mm-hmm. Obviously, the e-commerce, they're able to go into different countries a lot more nimbly. And at times they begin to establish a taxable presence in those places, maybe inadvertently by having an employee or different operations abroad. And they're just maybe not thinking about the U.S. tax implications of that. So that's what we see a lot of.
I thought the TCJA was going to simplify the tax code.
Of course.
That's what I was told.
Tax law always makes simplification, Dave. Of course, we know that.
Yeah, I remember getting a phone call from my dad, who worked in engineering his whole life after the TCJA passed, and he was told that it was going to simplify the tax code. He said, "Will you still have a job afterwards?" And I said, "Dad, yeah, they never simplify. They add to the tax code. If they add 3,000 pages, they might cut out 3, and they're not going to ever simplify it."
There's always when we have tax simplification, we also call that job security in the tax world, right, Dave?
Exactly.
So yeah.
So as companies are expanding globally, this compliance, it's more than just filing a standard U.S. return. So what are some of the reporting requirements that CPAs and clients need to be aware of that maybe they're not paying that much attention to?
Sure. So one of the things that is really a triggering event that all CPAs should be taking note of is anytime property, most cases money, is leaving the United States and going into a foreign operation, whether they're setting up an equivalent of an LLC in a foreign jurisdiction, if they're starting a corporation and they're sending money offshore, typically that's what they're going to do. Right away, they've triggered some reporting. So a Form 8938, for example. If they're sending money offshore, they have to let the government know that. If they have operations where they have control offshore, they're required, for example, I mentioned this form earlier, but a Form 5471 is a good example. If you have control of a foreign corporation, you're required on an annual basis to fill this form out. There's some calculations that go along with it. We call it the GILTI regime. And that could cause them to have a taxable income event in the U.S., even if they don't bring money back. And that was really the primary change of TCJA, that many offshore operations are now subject to this reporting that causes them to have income inclusions, where previously, if they weren't taking dividends back to the U.S., they just wouldn't have an income event.
Now, how much minutia do I have to worry about there? Is it, let's say, obviously, we're in the accounting profession. We hear a lot about people going, "Oh, I'm offshoring some of these forms, or I'm doing this, and I'm hiring this company in India or somewhere else to do this work," or some of them are even setting up an operations overseas to do it. Like, at what point is it minutia I don't have to worry about, and at what point is it something that really triggers it? As soon as I hire an employee overseas, or do I have to actually set up that kind of hang a shingle somewhere and be doing something?
So I think I'll delineate between hiring somebody that is actually an employee and hiring a contractor. Hiring a contractor offshore typically doesn't bring with it reporting requirements.
Mm-hmm.
Hiring an employee offshore almost certainly will bring reporting requirements locally, as well as for the U.S., for U.S. purposes. So, and if there's any entity that's set up offshore, immediately there's going to be reporting requirements, whether it's treated like a corporation for U.S. tax purposes, whether it's treated like a partnership, whether it's just a branch. They send a couple employees offshore and they have the equivalent of a branch. There's going to be U.S. reporting requirements, and it's going to raise the complexity of their return, I would say, substantially.
So what if I have somebody that works for me? Say they're a foreign national, they're allowed to work in the U.S., but their spouse gets transferred back to their home country, and I decide to keep them as an employee, but now they live in France or Germany or China. Does that trigger reporting? Is that something I need to take into consideration when that person might be moving around the world?
Yeah, so this is a tricky question, Dave. I would say that this requires some analysis. This is a gray area type question. So if I have a U.S. person that has to go overseas for some reason, and they're not generally performing duties that would create taxability in the local jurisdiction, generally I would be okay. Now, if they're paying taxes in that local country because they're a resident there, that individual's tax situation became very complicated.
Now,
Yeah.
that might have gotten into kind of some minutia, but what I'm actually curious about is, when are you seeing that companies are creating some type of exposure without even realizing it? What are some of those triggering things that you see that maybe you go meet with a manufacturing company or anybody else, and they don't even realize that they have international exposure?
It's good. It's a good question. I think I'm going to use this. I'll use a specific example if that's okay.
That would be great.
This is a situation where this was a U.S.-based company owned by a foreign corporation.
Mm-hmm.
The foreign corporation was working in conjunction with the U.S. company to do events in the United States. They sent 4 or 5 employees over a variety of time, and they were here for a couple years off and on. They had a very senior person that was actually executing contracts on behalf of the foreign company, but also benefiting the U.S. company. They did not realize that they had a real potential U.S. filing requirement because of that. So we did something called a permanent establishment analysis for them. It was very nuanced. It was detailed. We ended up with a rather lengthy memorandum laying out all the facts. And on a very, I'm going to say, a razor thin judgment, we determined that they did not have a U.S. taxable presence. But this was completely not on their radar. You know, they thought we have a U.S. company here, that U.S. company's earning some money. But the way that it was structured, there were still returns going back directly to the offshore entity. and we had multiple phone calls to sift through all that. It became pretty costly for them.
Mm-hmm.
And because we're taking a treaty position, they are going to have to file a form in the U.S. to declare that they're not taxable, but because they have a treaty-based position. So that's a really good example, I think, of a company in the normal processes of their doing their business, sending a few people over here, not realizing at all that they might be walking into a taxable income situation.
So you mentioned there that it's not actually creating a tax liability in that situation, but it does have compliance effects.
Correct.
So why do I even need to worry about it? If it's not affecting the bottom line of my tax return and not changing it, then do I still have a risk if I don't do the paperwork correctly?
This is a really good question, and this is a really good example of why they should be filing. So when you take a treaty-based position, if they did not file the return and they were to not prevail in their analysis because it was very close, somewhat of a judgment call. If the Internal Revenue Service became aware of this, and when you have lots of employees coming in and out, they have to file visas, so they're in the government system. And if they were to be audited, let's say, and they did not prevail on their treaty position, all of their expenses for that revenue would be disallowed. So let's say they generated $1 million of revenue. They had $900,000 of expenses attached to that. If they don't file the treaty-based position and they don't prevail, they haven't disclosed that, the $900,000 of deductions would be disallowed, and they would pay tax on the full $1 million.
Wow.
So there can be significant consequences in these types of situations when we don't properly comply.
And I might be wrong there, but and then some of the other things that you work on the international compliance, there's just penalties attached with the forms for missing them, or
yeah. I think the best way to think about this is, again, to use an example.
Mm-hmm.
So we recently had a client come to us, and they had one of their clients that was an individual, very benevolent people. It was a group of brothers. They had very successful business here in the United States. The brother had been on a mission trip back in the early 2000s, and he was actually in a European location. And to provide a local ministry type opportunity, he formed an entity to do milk farming of all the weird things. And what they didn't realize is they triggered a filing requirement from the U.S. because they formed an entity. They were required to file a Form 5471. And the penalties for not filing that form are $10,000 per year per form.
Wow.
And that fine can go up to $50,000 if they're notified and they don't comply. Every 90 days, it goes up another $10,000. So the tax liability on that's probably pretty nominal over time, even for an extended period of time.
Even in the milk farming?
Even in the milk farming, yes. And so it's very important that they comply. They're going to have to go back and remediate that, do a number of years depending on the circumstances. It could be as many as 10 years or as few as 4 years that they need to go back and comply, depending on what the status was in 2017, the year Tax Cuts and Jobs Act was passed. So we'll see what happens with that. I think they will do that, but the fines and penalties, if they were ever to be discovered, can be very substantial.
So based on those fines and penalties, it's not a good idea to just bury my head in the sand and hope nobody catches it?
Very much not a good idea.
Okay.
And I'll just say this specifically about that. We have the opportunity under a couple of different remediation policies that the government's put out to do this without fines and penalties. or to vastly reduce fines and penalties. If you are discovered prior to coming forward, then the whole game changes. So we would much rather that they would do it in advance and have some penalty protection for themselves.
Mm-hmm.
We have opportunity to file under something called reasonable cause, and it can greatly reduce their exposure.
So it sounds like this isn't, because when I think international compliance, obviously you think about the big companies, you think about the Exxon Mobils, you think about we're here in Indianapolis, the Eli Lillys, the large multinationals, but the examples you're giving, these aren't big companies.
Not
These
at all.
are, and so without somebody that can outsource a lot of this assistance, what does a small small CPA firm do? Do they just walk away from those clients in the past, or how do you, when you're going in and talking to, let's say, a small firm in Iowa that has 5 partners?
Sure.
What have they done in the past? Have they just ignored these things, or have they muddled through it?
I've seen a variety of different things. I've seen them ignore it. I've seen them not know that it exists at all. And I've seen them muddle through it with various levels of accuracy, I'll say. And when they turn to a firm like McGuire Sponsel, for example, and we're able to bring some international expertise, we're able to really help them and to either walk alongside them, do a review, or to actually have them turn that type of work over to us, and we work seamlessly with them to support them and their client needs.
So as we're thinking about this, as people move forward, because obviously the world's not getting smaller. I know there's a lot of push to obviously pull manufacturing into the U.S. We'll see how that works out over the next few years.
Sure.
But I don't think we can walk away from the fact that cross-border transactions, that you're going to see more of them every year. I mean, you've got to, even as companies are trying to bring stuff on, they're still making components overseas.
Sure.
That's not going away. So as we see this, do you think this compliance that we've been talking about, does it have to be discussed as a tax strategy as it goes with everything international? Does it have to be discussed with just tax planning in general?
If they have a client, whether it's an individual, partnership, S corp, corporation of any size, if they're going into a foreign jurisdiction, or if they have a foreign investor, someone that's going to be putting money to their company, they should seek out some advice on that structure and get a clear picture of the foreign compliance reporting prior to the event happening. The more proactive we can be on the front side, and if you're okay, I'll use another example.
I would love that.
Yeah, we had a company that came to us. They do property management, and they also have a bolt-on service that they provide with that, very seamless. And they were using some low-cost labor offshore, and they viewed this as another opportunity to start a business. They came to us, and they said, we would like to have you help us analyze this situation before we jump. So we put together 4 scenarios for them, different U.S. ownership structure, different foreign ownership structure, a blend of the 2 main scenarios, came up with a total of 4. We showed them what the compliance reporting was going to be up front, like here's what you need to do in scenario 1, scenario 2, 3, 4. And we also were able to help them make an analysis of, from a exposure perspective, legal exposure perspective, what their lowest exposure was from that perspective, based on how they structured it, and also what was their lowest overall tax cost, and then let them, choose a decision, make a decision that's best for them, and also show them everything on the front side. Here's what you're walking into when you go international. You have to do a Form 8938. You might have a Form 5471, which is for controlled foreign corporation, Form 8865, foreign partnership, 8858, which was in a branch scenario where they didn't set up an entity. Here's your exposure. Here's the forms you have to file. Here's how it's going to impact the shareholders all the way at the top of your U.S. partnership. Kind of soup to nuts. Here's what you're going to have to file in all these different scenarios.
I find interesting about that example is we think about these big companies, these big multinational
Sure.
manufacturing companies, the software developers, and you just brought up a property management company. That's not who I would traditionally think, hey, they might have some overseas exposure. So it shows the depth of how
Sure.
far this can go.
Sure. We've seen everything from this year. We did a consultation, and we're just getting ready to do the compliance on this. We had a U.S. citizen who was married to somebody in Europe. She is an author, and she had to set up an entity in the European jurisdiction. Because she's a U.S. citizen, she has to pay tax on her global income. She's going to have to always file a Form 1040. Ended up with extremely complex analysis, and she'll have reporting on international reporting forms for as long as she has this business now.
Oh.
Yeah.
Before we kind of close, are there any other kind of those interesting scenarios, those ones that kind of come out of the blue that you didn't expect that you wanted to share with anybody?
Yeah, I'll mention two things. One is, a lot of times people, they've lived abroad. They might have been a missionary. They might have had a job overseas, and they've opened a bank account somewhere, and they decided to leave some money back in whatever jurisdiction they were living in at the time. If they cross $10,000, they have something called FBAR filing. We see a lot of missed FBARs where people, they might be using TurboTax for their taxes. They have no idea that they have an exposure there. And somehow they get connected to a CPA that maybe they're starting another little business in the U.S. And suddenly they realize that they haven't filed these. CPAs like, you have a bank account offshore? And they have to go back at 6 years to remediate that. And the penalties for that are very, very egregious, very expensive, up to 50% of the balance of the offshore account. So that's a situation, that we see, I would say, quite regularly. And then, people that have just started a business somewhere and never told their CPA about it. We just see that, quite frequently.
Well, as somebody who grew up and lived in a lot of foreign countries when I was a kid, I'm glad my parents never opened a bank account for me because
For sure.
look, it's probably the only time I'll say, Mom and Dad, thank you for not putting money in my name in a bank account when I was a kid.
Yeah.
So, well, I think you gave us a lot to think about. I think there's a lot of opportunities, a lot of complexity that sometimes people kind of miss out on and just overlook. So I appreciate the time today. I think it's a really important that we think about as businesses continue to expand, as things change. The compliance is it's part of everyday life. It's part of the cost of global growth, but I think it's just the cost of doing business nowadays is that we can't ignore it. So I think it's critical that we see as businesses continue to grow that we take this into consideration. And I know I learned a lot today just hearing you talk about some of these smaller situations.
Absolutely.
That we don't think about. And so I think you helped a lot as we're talking to CPA firms, as CPAs and just business owners are listening to this, just understanding how to navigate some of these requirements and knowing that there are people like you that they can call that will walk them through some of this. I mean, you talked about some of the forms, but you also talked about where people have made mistakes and how to get out of it and how to kind of pull themselves out and not just bury their head in the sand and hope it goes away. No, we gotta open up and just rip the Band-Aid off and deal with it. And I had appreciated your insight. So thank you for that.
Thanks, Dave. I appreciate it.